Hello, so this is going to be my video explaining the strat and kind of the start of the video series, explaining it and how to trade it and all the other things that come along with that, with options and everything. So we will get right into this. So what is the strat? The strat was made by Rob Smith, and I don't take any credit for this. This is all his stuff. This is just me putting it in an organized place. So the strat is a price action based trading method that is 100% objective. So there's no indicators. We only use price action when trading the strat. The objectivity means that there is no guesswork when you're trading. So you always know what's going on, and you never walk up to your computer and you're like, well, how am I supposed to trade today? This is confusing, right? And this is beneficial because it allows you to remove all biases and only focus on what we know to be true or know is occurring within the market at any given time. So before we get into this, is a table of contents. So we're going to go over ones, twos, and threes. These are the only things that can occur within any type of market through the use of a candlestick chart. And then we will get into reversals because there's only a finite amount of reversals, and continuations because there's also a finite amount of continuation patterns, and broadening formations, which we'll get into that at the very end so I don't confuse you guys. So to start, we have the ones, twos, and threes because price cannot occur in any other way. So what are ones, twos, and threes? Well, they're labeled as such, and we'll start with the one. It's labeled as a one, and it's an inside bar, which is defined as a consolidation. Oops. There has not been a new high or a new low. So you can see this one, this is inside because it's no new high and there is no new low. So it's doing nothing, it's going sideways. And then we have a two, which is labeled again as a two, and it's a bar that took out the previous high or the previous low. And this is a bar we look to be trading because it's directional. You can tell this is a two to the upside because it took out the previous high. It's called a two up. Then we have a two to the downside because it took out the previous low. So it's a two down. And then labeled as a three, a bar that took out the previous bar's high and previous bar's low. So you can see higher high, lower low, and this is red, so it's a three to the downside. And here we go. So when identifying candles, we use the high and the low. You cannot ignore the wicks because price traded there. We can't ignore that data. And a three cannot occur without being a two first, which means in order to have a three, it has to be two up right here in green, and then it comes back in and goes red and starts coming back through. And a three is by definition a broadening formation, which we'll get into in a little bit. But all a broadening formation is a set of higher highs and lower lows. And then if you want to get the indicator for Thinkorswim, we have the ones, twos, and threes indicator. If you just click this picture right up here, and it'll link you to that, and you can just throw that in your Thinkorswim, and it should give you the ones, twos, and threes on your chart like this, except underneath the candlesticks. And for TradingView or something, we will throw that up in there sometime later tonight. So why are ones, twos, and threes important? Once again, they're the only thing that can occur within any given market when using a candlestick chart. So knowing that there's only three outcomes from one bar to the next statistically means that there's a finite amount of candlesticks that can occur from one bar to the next, and candlestick patterns that can occur because you have a limited amount of things you're picking from. So there's only so many patterns that can occur between all those three candlesticks. So therefore, we do not have to guess where price is going. It will tell us exactly that in real time as it occurs. So two, reversals, because we know there's only three candlesticks. And since there's only three candlesticks, there's only so many ways price can reverse and stop. We'll get into that in a sec. So what are reversals? Reversal is exactly what it sounds like. It's a point where price stops going down and begins going up, or stops going up and begins going down. So the strat gives us a unique view on this because we understand there's a finite amount of reversals, and we then understand exactly what they look like. So you can see this is a 2-1-2 reversal to the upside. So we'll start with inside bar reversals. They're one of the easiest to trade, and this is because they're very simple to scan for and recognize because they all start with a 1, because after an inside bar, my bad. So after an inside bar, there has to be a 2. There cannot be a candlestick that occurs that is not a 2 after 1. There could be another 1, but our entry is the break of the 1, and our target is the previous candle's low, the one previous to the 1. So this would be a 2-1-2 reversal to the downside because this was a 2 up, then we have the inside bar, then a 2 down. So it's a reversal. And then when looking to trade it, all you do is scan for the inside bar, which will be linked right up in here for Thinkorswim. And it works for any time frame minus the hourly because that's something we'll get into on the next video actually. So you can see we have the 2-1-2 reversal to the downside, the 2-1-2 reversal to the upside, and then the 3-1-2 to the downside and the 3-1-2 to the upside. And the way that you signify is just by the color of this candle for the threes, because if this is green, then it's a 3 up. If it's red, it's a 3 down. So you know that this is a reversal because this candle color is opposite of this one, and then vice versa. So now we have 2-2 reversals. So a normal 2-2 reversal is going to be harder to find and trade solely because it's a two candle pattern. So when looking to trade 2-2 reversals, you want to look for candles that are 2 up, took the previous high, and red, or 2 down, took the previous low, and green. So you can see we have the 2, we'll just say this is 2 down, and then we have the 2 down, and then it fails. So it goes from red, fails that side, and goes green and starts coming back through this candle. So now that closes 2 down, but it's green. So our entry would be right above there, and our target would be the previous candle high. So the reason that we look for candles like this is because we know an entry into a 2-2 reversal, we know the entry into a 2-2 reversal to the upside is going to be the high of the previous bar. So if we close green, we'll be more likely to reverse as we are closer to the previous candle's high, and vice versa. So if we close up here, statistically, it's going to be way easier for the candle to go and break this high to reverse back to the upside than it is to come down and break this low and continue to the downside. And then the same thing with a red 2 up. Hopefully that makes sense for you guys. So now we have 3 2-2 reversals. So these are going to be easier to scan for since it's a 3 candle pattern, meaning we can scan for the first 2 and trade the third. So it's the same exact thing as a normal 2-2, and you get the 3, the 2 down, fails, comes green, and you get the entry and the target, and then vice versa. And you can see these are examples right here. So this is a hammer candle, and it's because it looks like a hammer. Hopefully you can see that. And then we have a shooter candle because it's an inverse hammer. It's called like a shooting star, or a shooter is what we call them. So it's pretty much inverse hammer and hammer. So a rev strat. So a rev strat is a consolidation followed by an outside bar or a compound outside bar. And this is shown by the highlighted boxes. So you can see these 2 candles are outside of these 2 candles after you hit the magnitude or the target. And by the way, magnitude is going to be brought up a lot. All the magnitude is the target for this reversal. Because normally when a reversal occurs, price will continue going that way until there's a reversal against you. So the magnitude is for this candle to take out up here, but it will go further. So the magnitude's here, and then the targets would be anything else that's to the upside after the magnitude. So these highlighted boxes, you can see this is a compound 3 or compound outside bar because it's completely outside of this previous bar. And like I said before, that's a broadening formation. So we are trading through the broadening formation because this 2 takes out this and this, and then we come back through and take out the high. So that creates the higher high and the lower low. And we'll touch more on the broadening formation in a little bit. So when looking to trade a rev strat, there's 2 types. You have a 1-bar rev strat, which is shown down here. And you have a normal rev strat, which is a 1-2-2. So inside bar, 2 down, 2 up. And the latter is easier to scan for because it's a 3-bar setup. And you can see that's kind of a pattern here. While in contrast, a 1-3 is a 2-bar setup. So when you get a 1 and you take out the high and it go a different color and start coming back through, then you can kind of look to go short or long, but it's not really an actionable signal, which is something we'll get into in the future. So just know these are going to be a lot easier to play than these. So now we're going to get on to continuations, and you can see we have a 2-1-2 continuation shown here because price can only continue in so many ways. So what are continuations? A continuation is when price moves in one direction, consolidates, creates an inside bar, and then continues the move. So, gosh, I keep doing that. So trading continuations is best done when playing with stocks that have a higher volatility. You'd always want to take a reversal instead of continuations when trading because reversals have a higher chance of working. So this is because when trading a reversal, there are participants that are caught market participants that are caught short or long that are going to have to close their position when price goes against them when we would enter. So let me just show you an example. So anyone that got short on this 1-2 down, that 2 goes green, and then over our entry, anyone that got short in here now is completely underwater and they have to be a buyer right here. And anyone that got stopped out of their position is going to have to be a buyer if they're going to want to re-enter right over our entry right here. So we're kind of screwing anyone that got in here, and they're going to have to buy it up in the direction of our trade. So that's kind of like the psychology of how that works. And because of this, you'll have more buying pressure or selling pressure in the direction of your trade. When compared to continuations, there's simply just a consolidation, meaning those who were long or short previously don't have a reason to really enter or exit. And that means that there's going to be less buyers or sellers to push the trade in your direction, but we'll build on that a little bit in the future. So whenever I'm looking to trade continuations, it's definitely going to be on stocks that are moving more than they normally would, or just ones that move a lot. Like if you think Tesla, when it was running up, how it just went straight up, that's where you'd want to trade continuations because it's just going straight up. So here we go. So 2-1-2 continuations. A 2-1-2 continuation looks very similar to the reversal, but the first 2 is in the same direction that the second 2 breaks to. That's a lot of 2s. But so you can see we have the 2 up green, then we have the inside bar 1, and then the 2 up green in the same direction as this 2. So they're both green. So that's a continuation, and then vice versa for the 2-1-2 to the downside. And when looking to trade the continuation, there's something called a measured move, which is where you measure the high and low of the first 2 and then project it from your entry. An example is shown. So you can see this 2 right here, and then we have our entry right here. If you measure this, throw it to your entry, this is going to be the measured move. So we have the magnitude here, and then this is going to be your second target. Hopefully that makes sense. And continuations and reversals commonly go much further than their target. So like I said before, we're trading reversals. So if price is going down, reverse and starts going up, and it goes to your target given by the reversal and it keeps going, that's likely to happen because it's going to continue going. So now we have 2-2-2 continuations. They're not actionable, which is meaning something that we're not going to trade off of, but they do occur very often. You can see 2-2-2 to the downside, 2-2-2 to the upside. And now we're going to get on to broadening formations. So what is a broadening formation? A broadening formation is exactly what it sounds like. It's something that broadens. So when trading, we use broadening formations to gauge magnitude, where price is going, because they have to occur in order for price to trade up and down. So you can see like this. As shown previously, a 3 candle is by definition a broadening formation because it has made a higher high and a lower low in comparison to the previous candle, also known as broadening the range. So this is the example. This is a SPY monthly chart. So you can see we have the high, low, higher high, lower low, higher high, lower low, and then boom. Now you get inside and up. You get the 2-1-2 reversal off the lows on the monthly chart, and you go and take out that high, and we did. So how do they give us magnitude? So they give us magnitude through the use of compound outside bars. Compound outside bars occur when there is 2 or more bars that create a 3. So when they're compounded together, you'll notice that every single blank 2-2 reversal uses a compound outside bar as its target. The compound outside bars are shown in gray. So you can see the Rev Strat creates a broadening formation. 2-2 reversal creates a broadening formation because this took out the low, then this, our target, is to just take out the previous high right here, and that would make an outside bar. Same thing to the downside. And hopefully that makes sense for you guys. So all a broadening formation is telling us is that there's a higher high and a lower low. When drawing a broadening formation, you draw from front to back or right to left in order to get all of the data possible. Ideally, it should be a slight lower low and a slight higher high. So to add, a broadening formation is not saying we have to go and hit the upper or lower line of it. All it is saying is that with time continuity, something we'll get into in the second video, and without a reversal against us, we expect price to go to X price, the previous high. And I have a video explaining broadening formations more in depth. And then if you go up here and click this, this is going to be Rob Smith drawing the broadening formations. It's just a YouTube search. That'll bring up all his videos of examples of drawing them. So you can see entry, and then the low of the previous white bar is the magnitude, not the bottom of the broadening formation. So you can see this broadening formation, how it's occurring right here. This would be our target, not this, because all this is showing is that we're making compound outside bars. And the second we go a penny below this, this is compound outside bar of all this, making the lower low. So it doesn't have to go all the way down here, but many times it will. So why are all other price action trading patterns irrelevant? So if you're a successful trader or a trader who's been trying to use technical analysis in order to gain an edge, you'll be familiar with a cup and handle, failed cup and handle, or head and shoulders, failed head and shoulders. Why do these patterns have failed patterns next to them in every book? Because they're irrelevant to future price action. No matter what cup or head or pennant you see, they have no bearing on price action. And if you're brand new to trading and haven't used technical analysis, you can pretty much just skip this unless you're interested. So why all other patterns are irrelevant continued. So the simple answer is explained through multiple time frame analysis. We'll touch more on this in the second video. This is where you use multiple time frames in order to have continuity or confluence in the direction of your trade. Being at the top of a Bollinger Band on the monthly and weekly would be considered confluence or continuity by normal TA standards. So the higher time frame and a lower time frame both are at the top of a range. So you have confluence. They're both at extended areas. Hopefully that can make sense for you guys. That's just an example I was throwing in there for people that don't understand the strat yet. So when using multiple time frame analysis, if you have a head and shoulders on the daily chart and I pull up a monthly chart, there's not going to be a head and shoulders, meaning it's irrelevant to future price action. To add, patterns are inherently subjective when discussing normal TA. So subjective means there's no true or false pattern. It's just that kind of looks about right, which if you're going to be trading for a living, that's not something you want to be putting your livelihood on. It's just like, oh, that looks about right. No. So why else, you may ask? So since you've learned there's only 3 candle types, a 1, 2, and a 3, and we know a 3 is an outside bar, meaning a broadening formation, taking out both sides of the previous range, a broadening formation is logically can be the only pattern that has any relevance. It is given to us by the candlesticks, whereas there is no head and shoulders candlestick. So a 3 has to occur eventually if price is going to be going up and down, but a head and shoulders does not. And there's no head and shoulders candlestick, no cup and handle candlestick, so those are just completely irrelevant. And there is an argument for bull flags or consolidations due to inside bars, but a consolidation can be straight up or straight down, which would not make a bull flag. Therefore, those are irrelevant as well. Why all of this is important to grasp. So the strat is by definition a non-subjective trading or market framework. When Rob Smith created the strat, he took a unique perspective on the market. Instead of looking at price like a physicist with oscillators and other indicators using moving averages and momentum trading and whatever, he looked at it as a data scientist. So when looking at the market through the lens of a data scientist, you cannot have any subjectivity. Everything that you have read thus far has to occur within the market. There are no more than 3 types of candles and no other reversals that can occur. With just this information, you'll begin to see things differently. So here's some examples of broadening formations on the higher time frames. So you can see this is CCL on the yearly time frame. You can see low, higher high, lower low, higher high, lower low. Just keeps on going. Baidu, you can see we have the lower low here. Actually, so we'll go through off of this. So we have a lower low to here, higher high to this, higher high to this, lower low to all this, and then we have a higher high to all that, and look at that, we're all coming back in. And then we have, this is URA, which is uranium, and you can see we have the lower low, higher high, and this was all drawn previously. Look exactly where price stopped. That doesn't always happen, but it does happen sometimes. So broadening formations on the daily chart. So this is WY, I forget exactly what it is, but you can see this started a long time ago and it was like that, and then it expanded, so slightly lower low, then you have the higher highs, and then boom, 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 boom. This is all in sidebar of all this, and then we make the higher high, come up to the top of the broadening formation, reject it, start coming back in, and then pins. So you can see starts like this, and then we get a range expansion where we just go outside of it. That does not make the broadening formation not correct or anything. It just means that price is broadening higher than it was previously. And you can see we expanded it, and then we boom came all the way back through here. So you're never not trading through a broadening range. You have to be. And then we have some examples on the minute chart, and this is one we actually traded in the Discord not too long ago on Friday. So this is the Tesla 1 minute chart. I drew it like this, and then we got a little expansion, and then boom, rip right back through. And you can see, then now we made lower low to this, and then took out this high. And then this is on Bitcoin on the minute chart. So you can see, boom, boom. This is where you get the lines. Expansion, expansion, bounce, expansion. Hopefully you get what I'm putting down. So what's going to be covered next? So there's a few more pieces to the puzzle. So kind of like the psychology of what occurs in the market. So why the candlesticks work, which isn't super important to know, but it's definitely interesting and helps kind of with understanding how you're trading. And then multiple time frame analysis, or time frame continuity as we call it, and pivots in relation to broadening formations. These can be slightly confusing and will take a bit to grasp, but don't be discouraged by that. And then after those concepts are understood, we'll talk more about entering trades and managing those trades using the strat. And this is subjective and will be where you decide what type of trader you'll be, like a swing trader, day trader, scalper, etc. So kind of what time frame you're going to be trading. And then options trading with the strat. So what are options, how to value them. This is going to be a separate one of the series, by the way. Incorporating them into the strat, strikes and dates, and then why you have to walk away from setups due to the options chain. And then that is going to be all for this video. I don't really have a schedule going for this, but I'll try and get about one of these out a week going into the future. So hopefully this helped with anyone that's new to the strat or just curious, and I will see you guys next time.